All right, Whitney, we're about a minute and 15 seconds out. I can go ahead and stop share on my side. When you're ready, just click that share screen button. We'll make sure everything looks good.
Awesome.
All right, screen share looks great. And I will lead us off momentarily with an intro. We'll be all set to go.
Awesome. Oh, my book, you guys keep not updating the bio. I don't know why, but it's Money for Tomorrow, How to Build and Protect Generational Wealth. Not a sensible guide or whatever. Or
Money
you could
for
just say Money for
tomorrow,
Tomorrow.
how to build and protect generational wealth. Yeah,
Yeah.
that's what I've got here.
Oh, okay, perfect.
All right, everyone, welcome back to Money Show's virtual Expo Fixed Income Forum. Thanks so much for being here. We're pleased to welcome Whitney Elkins Hutton. She's the Director of Investor Education at PassiveInvesting.com, author of Money for Tomorrow, How to Build and Protect Generational Wealth, published with Bigger Pockets, co-author of the international #1 bestseller Resilient Women in Life and Business, host of the Passive Income Made Simple YouTube show and podcast, and a partner in 800 million plus in real estate, including over 6,500 residential units, 15 express car washes, and more than 2,200 self-storage units across 11 states, and experience flipping over 5 million in residential real estate. Whitney, thank you so much for being here today. It's all yours.
Awesome. Well, thank you so much for having me on. And yes, we are talking about fixed income. So today we're going to talk about some assets that I consider beyond the bond and how can we actually put these assets together in order to build a modern type of fixed income playbook for 2026. Now, okay, so you're in the right place if you are wanting to learn how to take your active income and savings and turn it into passive income, right? That's why we're here this month with the Money Show. But I also want to show you how to not only turn it into passive income, but also to long-term wealth. If you're just like, ooh, I'm about 10 to 15 years away from retirement, but I really like the idea of having additional streams of income coming into play. Now, here's the thing. I want to recognize that, there are reasons why people have not added fixed income to their portfolio. Maybe you are looking at private investments and you just really haven't figured out how to underwrite one really well, or you actually invested in a private, realty investment, be it equity investment or a debt investment and you're just like, oops, I don't think this was the right deal for me. Or what probably most of you guys are, you just want to sharpen your skills. And so, if we haven't met before on previous Money Show episodes, my name is Whitney Elkins Hutton. I'm the Director of Investor Education at PassiveInvesting.com. And what I get to do is spend time with you, the investor, to help you learn the ins and outs of how to use these different tools to either kick off building your portfolio or to scale it, or to right now, what we're talking about, how do we pivot it to add in that fixed some income stream? Now, for me, the whole reason why I got into real estate back completely by accident in 2002, so I could spend time with my family and do more traveling. And this type of investment that I'm going to show to you today is one of the big players that has kept me not only helped me build my financial freedom, but more importantly, with the rapid rise of interest rates in the past 3, 4 years, has actually kept me financially free. So it's very flexible. Now, again, all of this is in service of one thing. How do I get 100% control and choice on how to spend my time? That's the lens that I look through everything. And if you want to learn more specifically about my journey, check out my book, Money for Tomorrow, How to Build and Protect Generational Wealth. You can snag it on Amazon or Bigger Pockets there. I show you get the inside look at my brain on how I approach investing. And if you want to connect with me, one-on-one, as well as get additional educational tools, you can check me out at passiveinvestingwithwhitney.com. Okay, all the webinars that you're going to see in the Money Show this week, and of course, anything that you watch online, you have to remember it's education only. So it's not financial advice, legal advice, tax advice. Make sure we're taking this information back to your investing team. Now, normally I don't talk about specific numbers, but today I do want to talk about fixed income because I think one of the things that prevents investors from putting fixed income, and maybe this is you, is that you don't actually invest in fixed income assets because you don't know where to put it, what's the most tax optimized, or you just can't see beyond um, the equity growth and tax optimization that you get with going into equity investments. So I wanted to show you kind of a mathematical model. All right. So this is a portfolio, okay, of an investor that I well, I modeled this for the investor. They're weighing their decision here. Do I take $100,000 and add $50,000 a year for the next 10 years? If I put that into the money market, say I gave them a generous 4.5%, they would end up like, actually, this is if they start off with, sorry, $675,000. Okay, so maybe $3.1 million. But if they put the same portfolio, same structure into the stocks, bonds, and mutual funds in that public equities, they do get a bigger return, closer to 4.3. But if they put that portfolio into a debt ladder structured investment that rewarded them for every additional dollar they put into the investment, they actually can increase their return by almost 25, 30%. And I'm going to show you how they do that today. Um, but first, when we talk about debt funds, I want to make sure that we are anchored on the same definition and what makes them hot in today's market. Right now, I think a lot of people are, a lot of investors are still trying to figure out, do I go into an equity deal and harvest the tax benefits, but I don't really like the income that's being kicked off? And, is this operator solvent? Is this the right time to invest? There's still a lot of, question about the equity side of things. That deserves a seat at the table because we can get actually a senior position that has a priority claim should the borrower not be able to perform, meaning that the lender can actually take back the asset. Also, there's no tenants, toilets, or trash or termites when you invest in a debt asset. It can also help you diversify across your portfolio. So maybe I know a lot of investors that I work with, when I have them, actually itemize all the assets in their portfolio, and then I ask them very simply to put it in those assets into three risk tiers. Tier one being cash they can access in 30 days or less, meaning the reserves and their liquidity. Tier two, meaning that's cash flow. Again, they can liquidate that asset within, about 90 days if they needed to, but it's kicking off very high cash flow for them. And then tier three, which is more equity driven. It can be a controlled real estate asset. It can also be a private equity real estate asset. But when investors label their assets in one of those three tiers, we find that a lot of investors that I work with, they are probably 85, 90% overweighted in that tier three. Not that that's necessarily a bad thing if you understand the risk. So debt investments can actually help you diversify. And then the cool thing about doing an investment into a debt fund asset is that you, like going into other syndicated deals, you actually can take advantage of professional asset management and oversight of additional borrowers. So you're not just lending out on one note, you can actually be diversified across multiple notes, multiple borrowers, and multiple markets. Now, when we talk about a debt fund investment, I don't want to, project out there that we are talking about an either or situation. Okay, this is a tool in your toolbox to build and scale your portfolio, but more importantly, stabilize the portfolio. So, debt fund investments is part of a three-pillar approach. If we think of it as a three-legged stool, the debt fund investment, one, can provide us liquidity. Okay. One, it's cash flow that is earning. It can also be compounding growth. Um, it can be very highly liquid asset if we do it right. And I'm going to show you how to do it right. It's income that you can use today, or if we invest through, say, like a retirement account, be it a Roth account or a traditional IRA account or a solar 401k, we could actually either eliminate the taxation on that ordinary income, or we can defer that to a later point in time. And you can also continue to get growth in that portfolio through compounding. But again, remember the debt fund investment is not meant to replace equity investment, but to give a better balance to the portfolio. So when we look at debt fund investing, we have to, anchor around how it can help us grow. For one, it's going to help you if we invest correctly into a debt fund investment. It's going to help us preserve capital. But we have to make sure that the operator that's deploying the funds in a debt fund investment, one is deploying into preferably a fixed first lien position, that it's an asset backed by real estate or something, a hard asset that should the borrower not perform, they can take it back. And that they're actually lending on pretty low loan to value standards, around 65, 70%. We want to target, gross returns somewhere between, 8 to 10% ideally. If the higher the risk that you take, if you get up into the 11 and 12%, I do see those, but you're generally going to not be in first lien position anymore. Also, we want to look for debt funds that allow compounding, all right? We also Another cool feature to look for in a debt fund is how often can you reinvest? Are you, as the investor, being required to invest in, say, 25K, 50K, or 75K tranches? Or can you add to your investment in about, 1000K tranches? That way you can keep your stagnant cash earning on the sideline. It's very efficient. Now, tax optimization is kind of the elephant in the room. We will talk more about that later on, but we can actually put these debt fund investments into Roth IRAs, traditional IRAs, solo 401ks, other type of retirement vehicles, even a health savings account, and to help maximize after tax returns. And that in and of itself could save you about 24 to 30% on taxation, depending on what your tax bracket is. So again, we are making sure that we're using this as a tool in our three-legged portfolio that we're crafting. But here's the rub. Most investors that I work with will spend more time underwriting an equity deal or even buying a mattress than they do a debt fund because they assume that the debt fund is, lowest part of the capital stack, and so their money is not at risk. Okay. So let's actually start picking apart debt funds and picking apart like how these things get made up, where is the risk? Okay. And so first thing we have to understand is the capital stack. When we invest in a properly structured debt fund, we're in the lowest risk, lowest return part of the capital stack. We're closer to down here to probably the senior position. Okay. Because we are the bank. We're investing in a pool of notes of loans that have been made on a hard asset. In this case, what we're talking about is real estate. When you invest in an equity deal, you're in the common equity class. You're in the highest risk, highest return part of the capital stack. So when the market shifts, like it did, in 2022, and we saw interest rates skyrocket, the common equity class generally is at the highest risk for one, cash flow compression, but also loss of equity. Okay, that's nothing that, there are things that we can do to safeguard that. The biggest safeguard is making sure that you have enough reserves to where you can ride through the trough and come out the other side. Um, but if you have in your portfolio, if you structured it correctly and you've got some of these senior debt positions, maybe a little mezzanine debt positions, a little higher risk debt positions, this can actually help stabilize the cash flow of your portfolio because when the cash flow disappears up here in the common equity position, The cash flow in the lower part of our investment tiers will help supplant that, will help kind of keep you motoring through so you can get to the other side of the market. But the risk is just because it says senior debt or first lien position, a lot of people assume I'm at no risk. Okay. I'm in the safest part of the capital stack. And that's simply not true because that's just one part of underwriting a good debt fund. Okay. So we want to get deeper into our analysis and understand what are the different areas, that at least three main areas, and some additional questions that I'm going to arm you with that we need to really focus on and make sure we have answers to as we're looking at these different type of investments. So here are four different structures. Feel free to take a screen share of this. These are the different four parts of when I'm reviewing a debt fund, these are the four different parts of the structure that I'm looking at specifically to get a good grasp if this is something that I even want to further into. I look at this structure before I even underwrite the operator, the market, and the borrower. One, when I look at a debt fund, what position is it in? Is it in first position, senior debt position? Is it mezzanine debt or preferred equity? Okay, preferred equity. I know a lot of investors will treat that as a debt position, but remember, senior debt and mezzanine debt, you're an expense to the actual deal. You have to get paid, okay, or you get the asset back. Preferred equity positions, you have now flipped to partnership. And it is not, you're in partner with the operator. You either make money together, okay, or you do lose money together. Deals go sideways and south, okay? So your position will determine your payment priority. If we're going to go into a debt position, okay, if that the whole point is to go into an investment that's going to stabilize our portfolio and give us cash flow, I highly encourage investors, make sure that you're actually in a true debt position that is secured by an asset. The next part of the structure that we want to look at is what asset class are you actually investing in? Okay, again, this is like there's a whole continuum here of asset classes we can be invested in. We can be in residential real estate. It can be single family residential, like fix and flip. We can be in multifamily fix and flip. We can be in office, industrial, retail, self-storage. You name it. Everything, all deals are taking on debt right now. Each sector, each of these asset classes are going to carry its own risk profile. They're going to have their own market cycle and possibly even their own regulatory considerations, especially when we start getting into hospitality type investments. Okay, so understand where are you on that continuum as far as asset class exposure. The third thing that I will look at is development stage risk. Is this deal actually a stabilized deal? Okay, meaning I'm just, it'd be stabilized deal would be like I'm buying an investment property. It's already occupied. I might do like a couple like minor tweaks on the property, but I really don't have to do much in order to start harvesting cash flow. I'm not rehabbing units. I'm not doing huge, profit and loss statement overhauls. Or am I on the other swing? Am I doing more value add or more development type things? Okay, what part of the stage of development am I actually in? The further we go out into being into value add, ground up development, or even into entitlement phase with an asset, that's going to increase the risk of that particular debt fund. Okay, and then we have our investment structure. Are you actually doing peer-to-peer lending? Okay, am I writing you a loan? That's a single note. So I can have $100,000 and write you a single note. All $100,000 are exposed to one borrower, one note. Or I have $100,000 and I'm going into a debt fund where I am maybe immediately diversified across 450 loans and 100 different borrowers and multiple markets. Okay, I get instant diversification. Or am I going into like a crowdfunding or JV platform where I actually can invest maybe in smaller chunks, like a 10, 1K here, 5K there, 10K there, but I don't get any say in, what gets brought to that platform at all. I don't have any visibility into the back end borrower or the underwriting standards. I'm just, my capital is being deployed. Okay. Even the structure can affect liquidity terms, the fee arrangements, and your investor control rights. So these are the four main areas that I look at on any debt fund before I even start digging into who is offering the debt fund, what are their processes, and what are their protections. All right, so that brings us to the actual framework. Okay, once we look at a deal and we go, okay, it checks my box as far as my risk profile, where do I want to be? This is how I'm going to keep myself, if I invest in a debt fund, keep myself safe. Now I can look into due diligence framework. Okay, so I'm breaking this into three different categories. Who are the people? What are their processes? Okay. And then what protections are they putting in place in order to safeguard my money as an investor? So if I am actually adding in questions at each of these levels, the people, I'm looking not only at the operator that is raising the funds, but who is the lender deploying the funds? So I actually am underwriting two operators, not just one, with a debt fund. Okay, I want to see, many years of experience, preferably on the institutional level. I want to see them at minimal have gone through COVID, rise of interest rates, if not all the way back to 2008. I'd like to, understand, how are they doing? Are they investing alongside their LPs? How are they promoting transparency and reporting standards with their LPs as well on a monthly, quarterly, and annually basis? Um, their processes, okay? How are they underwriting the borrower? How are they underwriting the actual deal? Are they getting third-party valuation of the actual deal? Okay, either through a broker price opinion or an appraisal. How are they monitoring the borrower to the point that they know the borrower might be getting in trouble with the loan before the borrower actually knows they're getting in trouble? I want to understand those questions. And then how can they actually, have high customer service with the borrower? Because that too, that relationship is a huge process that can protect the investor. And then we get into risk mitigation standards. Okay. Again, we checked our four structural boxes. We want to be, if we're going to invest in debt, use it as a cash flow to create fixed income and stabilize our portfolio. Um, you know, let's look at first lien position opportunities. Okay. Understand what the loan to value or loan to cost ratios are on the projects. Is the loan that's being written, is it full recourse, okay, or non-recourse? How is the lender allowing the borrower to exit from a deal? So ideally, an exit would look like a refinance or a sale, but do they have their borrower sign up front, deed in lieu? Should they not perform, they get the asset back. Maybe they make them sell the property within 30 days if they can't perform. Or, at minimum, are they in states to where they can foreclose on the property? Now, I have eight other areas that I also like performing due diligence in. And I guess, I've seen people have like 100 point checklists on due diligence. These things that I'm showing you are going to get you about 80%, 85, 90% of the way there on underwriting a very solid deal. But again, we're going to dive in on the capital structure. I want to understand the concentration risk of the debt fund. Not only geographic concentration, but also is there a single borrower concentration? Okay, so if $50 million are being lent in the fund, but 25 of it is going to one particular borrower or maybe just three borrowers, that's kind of a risky proposition. The fund's not very diversified. I want to dive deeper into the underwriting standards. You know, what are their criteria in their underwriting of the borrower, and get very clear there. I want to get very clear on the loan to value ratios, our personal guarantees in place. What is the historical recovery rate on distressed assets? So in a debt fund, it's not a matter of if you're going to have a loan go to foreclosure or a deed in lieu. It's a matter of when and how does the borrower handle it and what is their default rate. Okay, we want to see that as low as possible. What is the liquidity? How can you as the investor get liquidity? Are you locked up, say, for 12 months, 24 months, 36 months? How are you stress testing this particular investment through different interest rate environments? Simple question is, did you have to pause distributions during COVID or in the last 3 years? How did the performance look like? Uh, this is a very important one. What are the fund level leverage? So does the operator take on lines of credit? Um, Now, that can be used to help flow the income going into the fund and out of the fund from redemptions. However, I've seen operators actually inflate their leverage on a fund in order to juice the returns to the investor. And so, to me, it's a very slippery slope. Okay. And that actually moves you as the LP from a first position lien protection down to a second, because if things go wrong in the fund, who gets paid first? The actual bank, not you, the investor. Okay. Which brings me to reserve policy and capital management. How is the operator ensuring, smooth income and inflows and outflows out of the fund and what reserves are being kept? So this is how it would look if you were underwriting, comparing, contrasting two different funds. Um, the fund, the institutional grade fund, that is our metrics. We're a first lien position debt provider. We love single family fix and flip real estate with 6 to 9 month exit timelines. We love small value add, almost stabilized assets. We have 450 plus loans in the fund at any point in time across multiple metropolitan service areas and borrowers. We offer monthly distributions and automatic reinvestment for compounding. Our default rate is one of the lowest in the market, 1.1% and falling. We've had zero deficiencies to the fund, and we don't lock up our investors' money, for investments $500,000 and lower, and we have a 90-day redemption period. Zero institutional lending on leverage on the fund, and an incredibly low break-even performance. So now there's always somebody that like will, ping me afterwards and says, "Hey, Whitney, I love your presentation. You have amazing information, but goodness, you have can you distill this down into the four main areas that I have to look at?" Okay, well, we did that earlier when we looked at the fund structure. But if we're getting deeper into due diligence, here are your big red flags in the deeper due diligence. If you see inadequate underwriting standards, red flag. If you see excessive loan leverage ratios, red flag. Inadequate workout infrastructure, meaning they can't actually exit a default very well, red flag. And if they're not monitoring their borrowers extremely closely, that's a red flag waiting to happen, quite honestly. So why does our debt fund fit the moment? Again, it's the senior lien position, institutional diversification, true preferred return. Our investors get paid like the bank. There is no bank financing or leverage on it, so they are in first position. They are the bank, and that gets paid before any expenses. Flexible distribution options, monthly, distribution, or you can compound that, as well. And then enhance liquidity access to those funds for investments 500,000 or more. And this gives you just a little bit of a sense of where we're invested. Our managing team has over 51 years of institutional real estate lending experience in North and South Carolina. We've expanded a little bit into Georgia, into Tennessee, and have followed our borrowers into other markets as well. But this is where 95% of our loans are. Incredibly low loan to leverage, loan to value standards. So one thing that I did want to bring up, when we talk about building this modern fixed income portfolio, a lot of people Or like Whitney, again, my objection, the reason why I don't want to go into a debt fund is because I can't give up the growth and compounding. Well, remember, we can put this type of investment into a tax structured um, tax advantage account like a retirement account or Roth IRA, traditional IRA. And then we can allow it to compound. And so you can actually get a tax-free equity-like return inside a retirement account is one of my favorite ways. Obviously, you can compound cash if you a cash investment, but this is one of my favorite ways to utilize uh, debt funds is to put it in your retirement account, set it and forget it and let it grow for you. And when you're ready to switch it to cash flow, remember you've been getting this, 17% compounded growth for quite a while. And then you have, the cash flow you can draw on. Now, we have just a minute. I want to take some questions, but for those people who want to actually understand the terms of our fund, want to reach out to me. Here is our tier distribution structure for our accredited investors. This is how investments like a debt fund can actually outperform the stock market. But for every dollar you're investing, you're actually getting rewarded with a higher interest rate. Whereas when you do this into normal equities portfolio, you just get more fees. All right, what questions do we have?
All right. Do have about a minute here for some questions. We had one question come in. Is your peer-to-peer investing in microloans?
We do not do peer-to-peer investing. I merely just mentioned that as a way to compare contrast. We do debt fund only. So our debt fund is that, our PIC real estate debt fund.
All right, excellent. Another viewer here. How do you advise investors to use alternative strategies like leveraging a 401k or promissory notes to fund their first few deals?
Uh, no operator should be advising you. That's actually a violation of the Securities and Exchange Commission standards. But what I can tell you, what I can educate you on is when it comes to debt fund investments, um, if I'm looking at cash, if we're looking from tax optimization lens, and you have say 100K cash and 100K in your retirement account, um, and if you do not need the cash flow, right? If this is purely for retirement, let's put this into a debt fund into a tax advantage account. There's so many different reasons why. I cover a lot of those on my Passive Investing Made Simple masterclass. You can find that on YouTube. You can reach out to me at passiveinvestingwithwhitney.com and we can actually have a conversation about your specific scenario. But if you need the cash flow, right, then put the debt fund, invested in cash, right? Like don't let your goals derail or tax optimization derail what your actual goals and needs are from your portfolio. So that's my advice on that.
All right, thank you very much. And we have time for one more here. We have a viewer asking, within the real estate debt fund, can you occasionally alternate between compounding and receiving the monthly income?
Uh, it's from a K1 perspective, it's we ask our investors to choose. So if you have multiple investments, it's easy. Like I've invested in cash and through my retirement accounts. My retirement accounts compound my cash. I take monthly because I want it to do other things. Um, if our investor initially compounds and then needs it like 2 years later and needs to flip it to cash, we can do like a one-time switch, not a problem. What we want to avoid, and I would say this for any debt fund, is the back and forth. Um, your your K1's probably going to get messed up. Like I have yet to meet an accountant that likes that when an investor split back and forth like that.
All right. Well, that puts us at time. Whitney, thank you so much for joining us today. Greatly appreciate
Yes,
you.
absolutely. You guys join me at passiveinvestingwithwhitney.com if you want to talk further about the PIC real estate debt fund.
All right. Have a great one. Thank you, everyone, for attending this session. Stick around. We have more great content coming your way for the rest of today and a full day tomorrow. So we'll be right back with you. Thanks for being here.
Woo! How many do we have in the room?
That I can't see. They just give me the controls to be able to start and stop the sessions,
Oh, goodness.
but I
Okay.
don't know. But Debbie or Charlotte, if you want to reach out to them, they might be able to get you that number.
Okay.